Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome back to the Australian Finance Podcast. I'm your host, Kate Campbell, and today I'm here for another wonderful Brain Hacks episode with my Brain Hacks co-host, Evan Lucas.
Hey, I'm co-host now, no longer a guest. I love it. Yes, we are now. What are we?
11th Brain Hacks episode?
So that's probably co-hosting. I agree with that.
We've been going for a while. Year, I think.
And not only that, before we go any further, all of you out there, thank you for your feedback. It's been great. We've loved it, and I'm glad that you guys are enjoying it. I'm glad also sort of slightly but surely sort of stealing some of your hosting duties off you because I want to keep asking you questions rather than you asking me. So,
the behavioural part of investing is the most interesting to me at the moment because once you've got the foundation sorted, you know what ETFs you're buying, you've got your bank account sorted, then the behavioural bit comes into play even more. And I find that the most interesting right now.
Yeah, because we're not rational. That's what we've been arguing through these last 11 episodes is to sit there and go, yeah, economics tries to make out that everything's rational. Well, that's just rubbish because we know we're not rational. We do things that aren't rational and shouldn't be rational. So that is why I agree with you. Behavioural economics is the most exciting thing going on at the moment. And that is why I think today you're going to do something slightly different, aren't you, with regards to talking about another book. Let's get it out. Go on. Get out the book. This book by a two-time previous guest of the Australian Finance Podcast. Mm-hmm. I also spoke to him years ago on my previous podcast, How to Money. It's called The Laws of Wealth by Dr Daniel Crosby. Now, he also has another book that listeners might have heard me mention before called The Behavioural Investor, which I think is a better starting point. Mm-hmm. This one's a little bit more advanced. But if you're a couple of years into your investing journey, want to learn about behavioural investing, you've read Psychology of Money, Laws of Wealth, Behavioural Investor, probably good next steps for you. And this is by a behavioural psychologist in the US. He's a great read, great follow online, so would recommend. But anyway, he talks about lots of things in this book, but specifically what I wanted to pull out today was he talks about behavioural risk and the different dimensions of that. And so he mentions 5 key things, and I thought I'd put each of these 5 things to you, Evan, and see what your thoughts are and how we can think about risk as investors. Because as you just mentioned, we're not rational. We do crazy stuff with our money, even if we have a great plan and we think we're on top of things. So how can we manage some of those behavioural risks as investors, or at least put some guide rails in place to stop ourselves going too wrong? Yeah, because before you go on, and I like this game, this is going to be fun, it's also basically one of the biggest Warren Buffett quotes of all time, which is risk comes from not knowing what you're doing. So again, that all feeds into what I think we're about to do. So I love a Warren Buffett quote. Just want to put that in there for you and get that ready to go. Is that, risk comes from not knowing. I would argue that risk comes from irrational thinking and not having proper things in place. So go, fire away. I'm ready.
I was about to say, do you know that I take a mental shot every time someone mentions Warren Buffett on the podcast? Because Owen manages to mention it maybe 5 times in every single episode.
Yeah, but there's acolytes, sort of an acolyte. So I'm somewhat there. But as I've said before, I don't want to be Warren Buffett. I do admire him. I think Owen wants to be Warren Buffett. You didn't hear that, mate?
I don't think he'll listen. So you're safe, Ev. All right. The first one he talks about is ego, and he describes that as overconfidence, defensive when ideas are challenged, confirmation bias, false consensus, and illusion of control.
Self-attribution bias.
Yeah. So, Evan, how does ego impact us as investors?
So, for investors, the biggest thing that always, self-attribution bias is the biggest conclusion of ego. And the reason I say that, if you don't know what it is basically the easiest conclusion is you are right when it works. The environment is what happened when it doesn't work. AKA never wrong, always right.
Okay, so if I invest in a company, it does really well, I made a great decision. If it does really badly,
it's the environment.
It's the market's fault.
Correct.
It's the people on Reddit's fault. It's the AFR's fault.
Yeah, exactly right. So that is ego. I mean, that is the simplest way to define ego in terms of the whole idea. It's a defensive mechanism. If you really want to go back to Sigmund Freud, who founded the word ego from id, ego, and superego, in that sort of psychoanalytical psychology division, the whole concept of ego is basically the balance between keeping your animal impressions down, the id, and your superego, which actually is your ability to rationally think. Your ego is just what controls everyday movement. And It's true. You've got to be honest with yourself. Ego is everywhere. I mean, it is a defense mechanism. It does protect you, and that's the term, from having to deal with the fact that you've made a mistake. Humans hate making mistakes. Everyone does. I mean, if you can't tell yourself and honestly say, I don't like making mistakes, then there is something incredibly interesting about you. But it's not going to be the normal thing. And then that's why when it comes to money, it's amplified. Because we also know from everything else in studies, along with probably what Daniel talks about, which is loss aversion starts coming in there. And a mistake in money is going to be lost. Let's put that out there very clearly. So it's got a double whammy. We know the impact that loss has, not just on money, but on inverted commas, any form of resource, right? If you lose a resource, the emotional impact that comes with that is significantly higher than finding a resource. So ego is absolutely there for a protection mechanism, but it blinds, and we know that. We know that it blinds. You don't have to just think about that with money or with finance. We know that ego gets in the way of understanding your capabilities or your overall success rate. Your ego is always going to overestimate where you sit.
How do you stop ego impacting your investment plan?
Again, going back to some of the brain hack episodes before, automation's a great one, straight out. Like, there is no doubt. If you can take decision-making away, so therefore taking self-attribution bias away from you because you're not making the decisions, the system is, then you can start reducing that ego. Don't forget, automation isn't perfect. So, you've had to tell it this is what you want it to do, and that could still make a mistake. But at least it's going to keep going on the projected path rather than letting your ego get in the way and stopping you when the mistake happens and goes, oh, it's the environment, as you said, and, such and such company has done this, and that's, that's fault, and I don't want to be in there anymore. If you actually go back to it, you probably at the start were much more rational than the mistake-inducing ego problem you have right now. So automation's clearly one of them. Again, it is also starting to say, okay, maybe it's even further than that, going, I don't want to be involved at all. Superannuation, great example, right? So in the point of view that your wealth is tied to the fact that you are putting 11% of your income into super and you can just watch it. Because in the end, super for most people, except for self-managed super funds, but for most people, superannuation has been run by somebody else and by an organization with many, many experts and many, many people. So it actually reduces. So they're probably the ways to say it. You're never going to beat it. I also want to put that out very clearly. It is completely innate, built-in issues with human beings for a reason. It's a protection mechanism. So don't get upset if you've got an ego. You've just got to accept it's part and parcel of being a person. It's about managing your ego.
Okay. So the next one we've got is emotion, which leads us to underrate the possibility of bad things happening to us, avoid thinking about what might go wrong, and ignoring the role that it plays in our decisions.
Small concept, jeepers. Okay, so yes, we know that, right? So emotion is, again, it all comes back into this whole concept of id and ego and superego from psychoanalytical discipline of psychology, but it also comes down to the fact that emotion is also a physiological problem. You need it to, again, fight or flight, protect yourself. Emotion also is a way with dealing with the situations that you find yourself in. The catch that we know is that obviously it releases certain hormones, etc., that do make you, inverted commas, and I do want to be very careful with this word, but this is the science word, irrational, right? Being emotional does not make you irrational, but that is the term, because what is described in theory as rational thinking, emotion can override. So again, the research would tell you that if you look at it from the point of view that if you had a choice between doubling your money by using leverage or going down the path of slowly but surely putting your money in, but also using some of that other money to spend on your family, that's emotion. Right, what I've just described, most people will choose the second option that I just said, because emotionally, you're more attached to your family than your money. The rational economics of going down, doubling your money using leverage, that isn't real, and emotion overrides that. So that's what I mean. It's not irrational. It's, inverted commas, reasonable thinking. That's what the argument comes down to. Emotion also helps you deal with everyday problems, but forgets about the future. So I know that. And your question is going to be, how do you get past emotion? Again, it's recognizing when you have it. It's also, automation's another part of it. Emotion is also trying to basically safeguard you again from a situation you find yourself into, whatever that happens to be. Again, looking at it from a finance, emotion can come around when somebody passes away. What happens in that scenario with regards to how people react is clearly going to be different. When money gets involved with estates, it gets quite, tricky. Have a will. Have that, forward planning with regards to estates is, again, an emotion that gets in the way of rational thinking versus reasonable. And a rational emotion can obviously lead to problems. So I've just given you a whole random heap of examples very, very quickly. But emotion isn't a bad thing. It's just something that is a physiological response to stimulus and situations, and about making sure that you're ready to deal with the risks that it can bring.
Yeah, and a huge part of the role of financial advisors when we've spoken to them in the past on the podcast is helping people manage emotion when it comes to investing and providing a sounding board when people are getting nervous because maybe the market's fallen and they've just started investing and they're getting really scared, they're getting nervous, and the financial advisor can talk to them and explain things and help bring them back to a sort of a level playing field.
Yeah, and the thing I've loved over the last, particularly since the Banking Royal Commission and since the FOFA laws and all this kind of stuff that have come in, has actually started to basically make sure that the advisor is no longer just looking at it as a transactional interaction, right? How are we going to best grow your wealth? This is it, full stop, no returns. Forgetting that you're dealing with a holistic scenario here. The person does not just come to them for that. So all of the new legislation is actually moving towards not just being an advisor, but the growing people of wealth coaches, who I know you've had, Karen Ely in here many times. Her thinking is becoming, thankfully, the future, because what she brings is a holistic approach, because it's not just about
a plan's not enough.
Yeah, but she will go back to you and address why your relationship and your emotions with money are the way they are. And she'll basically be able to almost do you a deep dive into your own personal psyche of, okay, hang on a minute, this experience or these experiences or this situation has actually formed your now and long-term view about why you have this relationship with money. So thankfully it's moving that way.
Yeah. All right. The next one he mentions is conservation. We like winning way much more than we like losing. For example, loss aversion, sunk cost fallacy, and zero cost bias.
I'm nodding here for those of you that can't actually watch what's doing. I find that term interesting. Conservation is not how I would probably devise the thing. I would agree. I think
he's probably talking about we like to conserve our resources.
Yeah, partly. But I also think the winning's the part of what he's trying to highlight here is that.
But sunk cost fallacy is a little bit different.
It is. But sunk cost fallacy, I think what he's alluding to there is that, again, first two, nobody wants to admit the ego. We're admitting wrong. Sunk cost fallacy is one that I've just written about for my second edition of Mind Over Money, in that I think it's a concept that's probably missed by a lot of people because it happens daily. I'm positive that you're sitting in your work environment and actually seeing sunk cost fallacy happening over and over and over again. Because
I just spoke to a friend the other day who's halfway through a university degree. They really are not enjoying it, but everyone around them saying, well, you've done half of it. You should just keep going.
Yeah.
But they're not really, none of their friends and family are thinking about the fact that would take another couple of years of their life because they're doing it part-time, plus another heap of HECS debts. So it's kind of like, oh, well, you're halfway, you should just keep going, but not actually saying, well, do I want to keep going?
And that happened exactly to me. I got halfway through my first degree in behavioral finance. Sorry, not in behavioral finance, in health science, and was like, this isn't for me. But I was 18 months in, I had 18 months to go, and everybody was like, just finish it so then you can use that to leverage on. Now, in hindsight, you're right. I probably should have severed then and had the ability to start the thing I do love, which is this, which I did afterwards. But I wasted 18 months. And I don't even know it's a waste, but that's sunk cost, right? So again, you look at businesses that are sinking God knows how many hours of personal time, work time, and money into projects that they already know are in trouble. You see it all the time in terms of that space. And so that's winning as well. That's what he means by that. So I understand the conservation term. I maybe wouldn't have used it in that respect, but it's all about basically saying, I am not wrong and I want to win. I want to beat. I need to be better. Again, that also feeds into other things as well. Beating, winning, etc. means comparison. Comparison means also one of the most ugly things in human nature, envy. And that's all into this concept, is that if I meet defeat, I'm not as good as the other person. that other person's beating me and therefore I'm envious of what they've done. All of that you can already hear. If you add money or add finance into that cauldron of problem, that's where you get issues. So I've spoken about this before. It's not my new concept, but one of the most famous studies, which was by the Federal Reserve of Pennsylvania, showed that the most likely people to go bankrupt are the neighbours of lotto winners. And that is because envy absolutely comes to the fore, not realising that their neighbours come into luck and a windfall through no hard work of their own. They've just got luck and trying to keep up with them. I'm trying to beat them. I'm trying to therefore be bigger. So I would actually argue that's all inside of it. So his concept around conservative and conservation is about how do you actually get away from trying to win? How do you get away from keeping up with the Joneses effect? How do you get away from all that kind of stuff? Again, it is similar before. It's automation. It is the concept of running your own race. It is, again, disassociating yourselves with mechanisms or triggers, social media, that get you into...
Email marketing.
Yeah,
gets
correct.
you over time.
That get you into the mistakes that lead to this whole concept of trying to beat, trying to win, envy.
The next behavioural risk he talks about is information, which he describes as the risk occurs when incomplete, flawed or misweighted data gives rise to decisions that are equally defective.
I want to ask you that question because this is one of your big points. This is one of your big things, is not just analysis paralysis, but information overload. And how do you judge what's good and bad information?
It is very hard as a new investor because every piece of information feels very important or not important, and you don't know how to weight things accordingly. Because we talk a lot about doing your own research, but as a new investor, that's very hard. What does that look like? How do you make sure you're getting different sources? How do you even know what biases people are writing or producing this content under? So it does require quite a bit of work at the start to sort of filter through a lot of the noise. And even if you're just starting somewhere basic like the Money Smart website, getting some foundations so that when you're looking at everyone else's content, you've at least got some sort of lens to look through that is
baseline, isn't it?
Mostly impartial.
Yeah, I think that's a really good, because I was going to ask you, what and how do you get around information overload and what is your baseline? So I agree with you. Money Smart is a completely non-partisan base point. It is just... it's very dry, but it is, because it's dry, it's a good thing from the point of view that it is no fluff. There is no, sort of additional information. It is literally very, very factual. You will need to go further because it's probably not enough information, but it gives you the baseline. So when it sits there and goes, have a look at a savings account that is giving you savings above inflation and the current inflation rate is 4%.
Yeah.
That's great because it gives you your baseline. It's probably not enough information. No. But Money Smart at least starts you there. I think also the same with their calculators. It's why I like them. The calculators have no bias in them. They're not trying to push you into certainly something, some idea or some portfolio construction or what have you. It is literally, if you put this amount of money away for X amount of years at this rate, this is what will happen. But it doesn't go that next step. So that's the baseline. So I agree with you. I think in this world, and again, I'm going to put our hands up and say we're probably part of it, right? And we're open. We've been honest. We've got our biases. We've got our leanings. So always take what we say with, interest, but not absolutely 110% fact, which obviously is a misnomer because there's no such thing as 110%. Because you just need to keep finding that way. So use that baseline, use that information baseline. And I think Kate's bang on. Start at a government website and then work from there.
Yeah, because you do need to look outside and look at different sources, because if you're just listening to what your parents are telling you about money, you might have only one perspective, or it might not even be the correct perspective. They might not have been taught the right information. And so they're telling you one thing and it might lead you down a path that takes you a long time to come back from. So it is important to ask questions, be curious, and make sure you get information from different sources. All right. The final one he has is the behavioural risk of attention. I don't know why I said that weirdly, but anyway. Our attention can be hijacked by low probability, high scariness things. So he gives the examples of anchoring, availability bias, attention bias, and home bias. And one of the big times that comes up is for Australians investing. We know that a lot of Australians just focus on companies that are located inside our borders, that we can walk down Collins Street in Melbourne and we can see, oh, that's Commonwealth Bank, oh, that's Telstra, that's BHP. And we get very focused on Australian companies.
Yep.
And we forget that there's a big wide world out there and that Australia only makes up a tiny percentage of the world's companies.
So we just talked about information. Some of the best information in this space comes from the ASX. Even though it's a listed company, tends to be that. And they do a huge study into this probably every half decade. So they're actually due to do their next one this year, I'm pretty sure, because the last one was 2019. So it should come out this year. So it is a little bit old. But what they found, COVID may have changed this. God, I hope it's true. But their 2019 data compared to their previous one, which was all the way back 5 years before, looking at 2014, showed that in 2014, of all of the Australian investors, so not the whole community, of those that invest, it was 1.98, so near enough to 2 out of every 10 investors had some form of international exposure. Of those 2 people, only 2% of their portfolio was internationally exposed. So think about how that works. 2019, it jumped up to 4. So thankfully, 4 in 10 people now invest internationally. The catch, the 2% hadn't changed. So still that familiarity bias, and it's not just Australia, we are really bad at it. I want to highlight that very clearly. We do have a very large thing. Again, it's interesting talking to somebody, particularly people from Europe, when they hear us say international shares, they don't use that term because international doesn't really exist considering the European Union is technically, if you're investing in a French company and you live in Germany and vice versa, that's inverted commas international. That's our thinking. They don't think like that. So that actually helps them immediately. So they find it quite interesting that we use that term. It is and has been hard to do, right? And it's only in the last 10 years now. It used to be a little bit worse than that, but I still remember when I first really started doing this in full swing just before the GFC. So that's a long time ago now. You had double brokerage problems, as we refer to it. So you'd have to go to your broker, whoever that happened to be, you'd pay them. They would then send your order to the US, for example. That broker would take a fee to brokerage there, and then you'd have to do it on the way back too. So the broker in the States would then charge you, that would charge the broker that you originally had, that broker would charge you. So it was 4 times in terms of the charging. So it was just too hard. Thankfully, the rise of things like exchange-traded funds and all that stuff has broken that barrier down. But, and it is a but, we still don't do it. And this is the familiarity bias. Other things you spoke in there that we have listened to 2 episodes ago, we talked about this in the 5 things to remember. Attention bias, absolutely. Glittering prizes, as I refer to it. If it's going to catch your attention, cryptocurrency, meme stocks, the GameStop, phenomenon. That is attention bias 101. It is literally, you've got a minuscule amount of information out of a whole universe. Everyone's doing it. They're making money, therefore so should I. It is one of the biggest pitfalls for new players.
Yeah.
And old players alike.
It gets everyone.
Because I also want to play, the story that I've spoken about, and I wrote about this myself, was I had a friend of mine who is, and I'm not going to mention who it is, who's a brilliant investor. I've always, admired what they've done. But I remember to the day, March 7, 2020, COVID peak, Australia globe went into the lockdown. So Australia happened 24 hours after the rest of the world. And if you can remember that day, I'm pretty sure the market fell about 8.5% in one day alone. And he rang me up and said, this is the one. This is it. This is the end of the world for finance. And he was talking about selling his entire portfolios, right? Because again, his attention was on one thing and it confirmed what he starts from. He starts from a bearish position and then works backwards. So it all came to a head. Confirmation bias, attention bias, bang, bad decision. And I just sat there and went, you insane? I was like, COVID will finish. COVID will peter out. It might take years, and it has still, and it will be with us forever. We know that. But the economic impact of COVID is petering right out. But he lost that objectivity. And that's exactly what this is all about, is that the whole thing that comes with all of these biases, they're attuned to today, and they are and will have an effect that you probably don't need to look at. So how do you break them? Again, it's not just, this one isn't just about automation. This is also about having your long-term strategic plans locked into systems you can't break. Understanding that international shares on average, return about 10.5% versus the ASX, which about 8.5% to 9%. That different matters. So it's diversification. It's getting down to Harry Markowitz and, portfolio theory and making sure that you are diversified, making sure that you are understanding that putting all of your eggs in one basket won't happen. That will get you around the discussion we just had.
Yeah, and if you find your attention is being swayed every time you read a headline or you see a video or you see a podcast, then it might be a good idea to limit your inputs with that kind of information, and also limit the time you're spending looking at your brokerage account, because changing your investment plan every day doesn't usually end well. It usually ends up
and it doesn't work, right?
Yeah, you're not investing for a long period of time. You're incurring fees, you're incurring taxes. It's just not going to be good, and you're not going to be able to get on with your life and actually enjoy the wealth you're building.
Yeah, because, okay, there are people that do it for a living, but inverted commas trading is more likely than not to actually end up finding you in a loss-making position, because intraday movements of markets, intra-month, intra-week movements of markets are almost impossible to tell. And I need to put that out very clearly. I mean, some people will tell you they can with, technical analysis and whatever else, and that's fine. But overall, the long-term trend is that they'll either be brought back to the market trend, and once you include, as Kate just said, all of the fees, they'll be below. They'll actually be a loss-making because they've put so many in and out trades, in and out costs, that actually overall, when they return to the market, even if they were outperforming, overall that trend will be lower because of the amount of money they've spent. So again, don't fight what you're trying to do, right? Don't fight the longer term concept that you have. This also feeds into something like hyperbolic discounting, and hyperbolic discounting is the concept that actually human beings think short term in much larger return scales, whereas in longer term, they actually think in much more realistic. So the study shows that if you ask the average American what they think per annum they should be getting, the average response is about 15 to 20%. Now that is not double, but close to double the average of the S&P 500. In Australia, thankfully, we're a little bit less, but not much. It's between 12 and 15% if you ask the average person what they want per annum. If you change that question and say, what is the longer-term average that you want from your superannuation, the response gets much, much more realistic. Actually, I think I want between 7 and 9%. That is the long-term average. So that's what they call hyperbolic discounting, is that the shorter the term, the more return. The longer the time, the shorter, or the lower the return. And we also might explain why we are okay with credit cards. Credit cards charge you 20%, but we're okay with that. Whereas if we were to turn around and tell you a home loan was 20%, you'd never take that in a heartbeat. So it's this concept of, what they refer to as hyperbolic discounting, which is the inversion of what should happen. Rational economics tells you that longer term, the return should be larger, but we think the other way around.
So I think you'll see in this episode, there's a lot of behavioral risks that can impact our financial plan. But if we do things like automating our finances, we're reducing the time looking at financial news in our brokerage account, we're thinking about where we get our information from, we're using tools, maybe we're talking to a financial advisor to help us stay accountable and remove some of the emotion where we can. I think that's a lot of things we can do to help reduce the impact that we have, acknowledging that we will always be impacted by our behaviour when it comes to our money and investing. All right, Evan. Well, that about wraps up this episode of Brain Hacks. Thank you very much for joining me.
Thank you very much, Amy. That was fantastic. I really enjoyed that. I'm going to now go out and buy the Laws of Wealth and have a really good listen and have a good read. Fantastic topic. And again, as for all of you out there, as I said at the start, thank you for sending in your feedback. Please get out there and give it back to Kate at the Rask Media email address or on their line. We love to hear it, and we look forward to seeing you at the next episode of Brain Hacks.
Amazing. And if you want to listen to a full episode with Dr. Daniel Crosby, I have linked that in the show notes as well. Thank you for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.